Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today, we're talking about infrastructure investment trusts, which have been dealt a number of challenges over the past 3 years, from higher interest rates to cost disclosure problems. But could prospects for the sector be about to change? Today, we're looking at the challenges and opportunities for infrastructure trusts this year, and I'm delighted to be joined by three managers from the infrastructure sector. We have with us Philip Kent, who's the lead advisor of GCP Infrastructure Investments, Jean-Hugues de Lamaze, partner at Redwheel-Ecofin and portfolio manager of Ecofin Global Utilities and Infrastructure, and Benn Mikula, CEO and managing partner at Cordiant Capital, which manages Cordiant Digital Infrastructure. Great. On to the questions. It's been a challenging time for infrastructure. What's the outlook for your trust in 2025? And I'd like to start with Phil.
Great. Thanks, Annabelle. I think 2025 has the potential to be a really exciting year for infrastructure investing. I think if we look at the role of infrastructure, it really is to build assets that are going to address some of society's biggest challenges. And I think we've got quite a lot to do. Certainly from a UK perspective, if we look at the challenges around decarbonisation, we have a new government that's looking to set a new agenda and a new timeframe for decarbonisation. We've got digital infrastructure needs as the growth of AI and the digital economy grows significantly, as well as a growing aging population and the need to develop new infrastructure to support the population dynamics. So from an investment perspective, we're starting to see policy align with some of those social needs, which is creating some really interesting investment opportunities. And I think the final thing I'll say is the macro backdrop with a falling interest rate environment, we also hope will mean that the relative attractiveness of infrastructure, which historically has been a very income-focused asset class, is reset in a lower interest rate environment.
Yes, those interest rate cuts would be very welcome. So Ben, what's the outlook for your trust?
Thank you very much, Annabelle. I'd be remiss in not mentioning that Cordiant manages several trusts. We also manage Cordiant Hydrogen One, but I'm here today to talk about digital, which is a truly exciting corner of the economy. Digital infrastructure is effectively the plumbing of the internet. It's the third largest infrastructure category globally after roads and power, and it's growing. The growth is robust, and there's probably a 10-year secular tailwind. That growth rate is quite independent of artificial intelligence. We've assembled a very high-performing portfolio of data centers, backbone fiber, and communications towers across Europe and the United States. We've done it at attractive prices, and we have plenty of potential to invest growth capital expenditure to extend the revenue frontier of these assets. So we're quite excited, and I would just say that one of the things we're most concerned about, frankly, is something that you made reference to, which is ending this inappropriate double counting of fees, the weight of inappropriate regulation by the FCA. But looking ahead, the outlook for digital infrastructure itself is bright.
Great. Well, we'll come to cost disclosure in a minute. But Jean-Hugues, obviously you invest in listed infrastructure. What's the outlook for your trust?
Thank you, Annabelle. Yes, listed infrastructure stocks have been affected over the past 3 years, I should say, by the trends in interest rates from bond yields, and also the perception that most of those operators would struggle to pass through the effects of inflation. What is interesting, and what we can see from the companies in our universe and in our portfolio, is that actually the fundamentals and the outlook have not only not deteriorated, but they've actually become much stronger. And we see significant drivers of such growth and outlook ahead of us, and notably in the next year. What is interesting is notably what's happening with power demand. We're coming out of a period of about 20 years of flat electricity consumption in the major economies. Expectations are that power demand will increase by about 40% in the next 20 years. That's on the back of data centers, just alluded to it. That's on the back of electric vehicles, but also more generally speaking about a trend towards electrification, notably of the building industry. This is a major growth driver. And we believe this is going to be a driver of earnings and actually profitability, returns, cash flows for the operators in the space. So when we see the outlook, the fundamental outlook, it looks very sound. If anything, the political changes could actually even enhance it further by slowing down the pace of new capacity additions in power supply, which could actually boost power prices. That would be a further and incremental positive factor for the space.
Well, that's very exciting, this increase in power demand, really exciting. Moving on, why should investor consider your trust right now? And we've already talked about maybe rates coming down, but what's going to be the catalyst that we think is going to turn this, what is a great prospect around in terms of getting investors in? And I'd like to start off with Benn, please.
We have a very specialist product, and the reason to invest in this sector specialist trust is because we offer exposure to the digital economy, to the plumbing of the digital economy, for which we seem to have an insatiable demand. This video conference would not have been able to take place not even a decade ago. We use systems such as Teams. The amount of data that is sent back and forth for entertainment purposes and for business purposes is absolutely staggering, and governments are belatedly beginning to digitize to seek some forms of efficiency. Taken together, this is a multi-year trend, and if you'd like, precise exposure to it, that's what we offer. I think there are some additional things that can potentially help. Ending feed disclosure. I know I hammer on about this, but it's such an important issue. Ending the inappropriate fee disclosure rules would help, as would the government creating a framework for more pension capital to flow into listed alternatives. This is an ideal solution for both defined benefit and defined contribution plans. And should that happen, it would provide a flood of liquidity that could help all of these trusts close the valuation gaps and potentially even return to the heady days of trading at a premium.
Absolutely, revitalising London stock market and getting those pension investors in is very important. Now, Jean-Hugues, what about you? What do you think? Why is your trust attractive right now for investors?
We believe it's attractive mostly because of the fundamental outlook that I just described, but also because our investment universe is trading on its historic lows in terms of relative valuation. When you look at relative PEs, and again in the context of accelerating earnings growth, you're very much trading on multiples which make little sense, and very much dismantled, again, by the context of rising interest rates and inflation over the past 3 years. So this derating that we've seen of the space, in our view, is actually an opportunity to acquire high-quality assets with very solid outlook on the cheap. And those who have identified this opportunity seems to be the private equity operators, who are currently finding very attractive, kind of acquisition opportunities in listed infrastructure at actually significant discount to the valuation levels that they are ready to pay, and considering the massive amount of cash that the large private infrastructure specialists have raised over the past few years, this, in our view, can only bode well for listed valuations going forward. I would add a last point is that EGL, so Ecofin Global Utilities Investment Trust, currently trades at a discount, 10 to 12%, more or less at the moment, while it was trading at a premium until kind of mid-2023. Again, it's derated in line with a lot of the infrastructure assets, but we believe for unjustified reasons to a large extent. So this is a double opportunity to buy those assets on the cheap, we think.
Yeah, well, it's really interesting that private equity is identifying the opportunity, but the investors aren't. They really need to wake up to this. Phil, how about you? What do you think could turn this around? Why should people be buying your trust?
So I think in terms of reasons to look at GCP infrastructure investments now, so GCP Infra IPO'd back in 2010. It's got a 14-year track record of paying a stable, sustainable, attractive level of dividend. And where we sit today, we have a portfolio of assets of around £1 billion that's well diversified across multiple sectors, so renewables, PFI, PPP, and social housing. 99% of the portfolio is operational, so it's a mature and diverse portfolio with a long track record of delivering an attractive income that today you can access at around a 10% dividend yield on where the share price is trading. And I echo John Hughes's comments that we find ourselves at a discount in terms of share price to NAV that's pretty unprecedented for the majority of the fund's life. We've traded at a premium to NAV, and that means the discount that investors can access the shares at today provides that really attractive income on a mature, diverse portfolio. I think looking to the catalysts, and I guess I see GCP Infra as an attractive investment in its own right. If you layer on top, I think, some of the catalysts for a re-rating, as we started off the conversation, I think policy is aligning with the need for new infrastructure, and I think that will create many exciting investment opportunities for companies like GCP Infrastructure. I think the policy environment around interest rates will certainly help. I'd also agree with Ben's comments that there is a UK liquidity market failing that's been part of the challenge we've had, whether that's cost disclosure or lack of investors outside of wealth managers, multi-asset managers participating in the investment trust space that we also need to address. I think we have to work hard to sell the benefits of investment companies as a way of accessing attractive, diversified, specific asset classes for investors as part of a diversified portfolio. So I think we'll continue to do that work. I guess today is part of that long journey, but also I think regulation needs to address the liquidity market failing that's happened.
I completely agree, and we will continue to work on cost disclosure, but we will also continue to make sure we get the message out, the positive messages about infrastructure investment trusts providing solid, stable incomes in an inflation-proof way. And, with talk of recession, in a recession-proof type assets. So moving on to what are the biggest risks in your portfolio? And I want to ask that question to Jean-Hugues.
Sure. Well, the biggest risk short-term in listed markets clearly is related to interest rates. If we don't see this mean reversion in the trends in long bond yields and the yield curves, the space will most likely remain kind of beaten up or at least unfavored. Us as investors try not to focus too much on that because this is very much related to the short term. More fundamentally, over the long run, the risks that are traditional in our space have much more to do with regulatory risk or political intervention risk. Political risk, we've seen a large proportion of it lately, with the election of Donald Trump being a major disruption factor, obviously, with general equity markets considering it as a headwind. I would say, first of all, it's not as straightforward at all. And I mentioned earlier the fact that in that case, political intervention could actually lead to higher power prices. But even beyond that, what I would say is that for a trust like EGL, the way we balance such risks of local regulatory or political intervention is very much by diversification of our portfolio. Our portfolio is global. We make sure we always keep a balance between regulatory frameworks, geographies, types of business models. And that is, in our way, the best way to offset the external risks that are attached to our investment universe. And it's quite specific to a trust like EGL. And it is a balance of risk which listed investments allow you to have.
Yeah, those diversified sectors, those diversified geographies, I can understand that they help you mitigate risk. Phil, what's the biggest risk to your portfolio?
I think as a diversified portfolio, there's a number of things we think about when we think about risks. I think certain asset classes are exposed to market risks, such as wholesale power prices. If we look at the wind or the solar in our portfolio, for example, as an infrastructure owner, infrastructure owners are very reliant on third parties to deliver services to those assets. So the creditworthiness of the supply chain and customer chain that you wrap assets around to monetize those assets is also something we need to pay close attention to. Operating risks is always something to consider. These are living, breathing assets that require people, processes, systems to make them work. So we have to look at the operational complexity of assets and how those things are being managed. And then finally, the legal regulatory framework in which those assets operate. That's both the fact we're a UK investor and we're therefore exposed to UK legislation changing, whether that's corporation tax, health and safety, environmental legislation, but also as a fund that specifically targets investments in asset classes with some form of public sector-backed revenue stream. Any changes to those support mechanisms will also have a potential impact. So they're the, I guess, asset-specific risks, and I'd echo everything my colleagues have said around the more macro risks around the rate environment being a really important dynamic for the sector as well.
Thanks so much, Phil. And Ben, obviously we're going to talk about cost disclosure, but what are the other greatest risks for your portfolio?
I would say, Annabelle, that if you read the papers over the last 2 days, you would think that the biggest risk for us is whether AI is a magic bubble or a magic growth ingredient for the economy. But I'd like to be at pains to stress that is not the core issue. Removing artificial intelligence, the digital sector is still growing faster than the economy as a whole. So I might slightly change the question from the biggest risk to the biggest hope. And that's, how do we raise more capital? Because our portfolio is well positioned and it will continue to perform well if we do not raise more capital. I suspect that's the case for many infrastructure investment companies on London. But if we can raise more capital, we can accelerate growth and do even more for investors. So that's what keeps me up at night. Solving this is as much a function of regulation and reviving the LSE. If it isn't solved, we will continue to perform well. We trade below 10 times. Listed digital infrastructure stocks are closer to 20 times EBITDA. We pay over a 4% dividend. And so if we continue to perform well, perhaps capital will be more accessible. But I think that's one of the core issues for the infrastructure sector as a whole.
Yeah, we've really got to get that message out there to regulators and investors that there is a huge opportunity here, but it's being frustrated at the moment. Moving on. How often do you see your projects and what kind of things do you look at when you go and see projects? And Phil, can you tell me that?
Yeah, sure. So we have a policy of 50 investments across our portfolio. Within each of those investments, in some cases, there's multiple different sites or assets, and we'll visit those at least once a year as a lender. And I guess those assets that perhaps need more time and attention we'll absolutely visit more often. So for me, it's why we do what we do. I think the thing I love about my job is the fact we're investing into real things, and we're seeing real things being built, being operational, delivering critical services to the end users, creating jobs and economic activity as part of them. So that's how we, certainly from a personal perspective, derive reward from what we do. So getting out and seeing that in action is really important. I also think every time you visit an asset, you learn something new, and you'd never approach an investment process or decision in the same way if you, as you would have if you've been to an asset and you've seen it through a construction period, through commissioning into operations. I think that's a really invaluable set of knowledge and circumstances that you bring to an investment process if you're investing in that asset class again. And in terms of what we look at, it's often you can get a lot from just how a site is being managed and run. Is it clean? Is it well maintained? That gives you a lot of confidence in the operators or the owners of the asset treating it with the respect and the care that ultimately you'd like to think the assets that we've invested in are being treated with. I think there's a lot of data points on assets, whether that's the volume an asset is producing, the price being achieved for its services, its operating cost base that we monitor constantly, whether we're at the asset or not. I think it's only really by going to the asset and speaking to the team on the ground you get that really granular understanding of how things operate and what circumstances might impact the key KPIs and numbers that we ultimately as investors care about.
Yeah, I can really understand the economic and social benefits of these projects, but you really have to be there, and then it really comes home to how they're benefiting the area. Ben, how often do you get out and see these projects, and what are you looking at when you go there?
Well, Annabelle, we don't actually view them as projects. We own actual companies and invest with a private equity style and a strong operational bias. Our team contains some very experienced industry executives who are able to impart wisdom and best practice from their companies to these middle-sized platform companies that we have in our portfolio. So we have monthly management calls with the companies lasting hours in cases. We have quarterly board meetings that are quite extensive deep dives into the performance. We have informal conversations weekly, if not more often. And we're constantly engaged with them by email, touching base on key issues. It's a hands-on style and a deeply engaged style. And I think it offers investors access to private equity meets infrastructure, as it were.
Yeah, that sounds really very exciting, quite honestly, and a major benefit for investors. Now, Jean-Hugues, obviously, you again invested in companies, in listed companies. So you're not going to see projects, but presumably you are going to see those companies and the regulators. What are you out there finding out?
Correct. Yes, we're going to meet with three types of people. Clearly, we spend a lot of time with the management teams of the companies we invest in and of our investment universe in general. We meet with CEOs, CFOs. We sometimes challenge them even, notably on sustainability matters and on strategic directions. So that's a critical part of our job. We actually have several hundreds of meetings every year with the companies in our space. We also meet with regulators and government officials. This is key because it's a space where you have a lot of local specificities. You need to be familiar with the local regulatory frameworks, and that's how also you can identify the issues and where potentially there's a risk ahead of us. And there's a third category of people we talk to is actually the street, I'm tempted to say. We like to have a good understanding of where our own analysis of companies in the space, how this stands relative to the consensus of analysts on the stock exchange. And, it's quite often when the consensus is depressed and the most negative, while fundamentals remain solid, that we identify the best investment opportunities. That is not so different from the situation we are in actually today.
Thank you so much, Jean-Hugues. It sounds great. You're out there seeing the companies, the regulators, but also the word on the street. I like that. You need to know what's going on. I'd really like to thank our managers very much for joining us today. It's been fascinating to hear their views. I'd like to emphasize that we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. Thank you so much for watching.